All right, everyone, let's go ahead and get started. People will certainly start to file in here in a few minutes. If you do have any questions, I do ask that you type those into the chat box, as all audio on your end has been muted. But today we're going to be covering small business retirement plans and kind of what it takes to set one up. Also, some implications for the upcoming extended filing deadline for those of you that are small business owners, and just in general, the contribution limits and plan choices that are available, along with some administrative options that you do have. A little bit about myself. My name is Alex Perny. I've been with Advanta since the beginning of 2012. I cut my teeth on the front end of my career actually doing investments for clients, and then transitioned over into my current role with doing education marketing and new business development. So if you do have any questions specific to stuff that is maybe more pointed towards the actual investment side of things, I can certainly answer those, as well as anything to do with setting up a plan, which plan you might want to choose, or anything else like that. Please don't hesitate to type those questions into the chat box. I will adjust those throughout the presentation. I don't feel like you need to wait for a particular time. And if you would like to reach out to me afterwards, feel free to reach out to me directly. My direct contact information is up on the screen in front of you, or if you are listening in and want to take it down, my direct line is 727-754-9954. You can reach me at any time during normal business hours. Now, as we are going to be covering quite a bit that has to do with making decisions that will directly affect you and your personal tax situation, as well as potentially your business, we need to read a quick disclaimer. Advanta IRA and our employees do not provide investment advice or endorse or promote any products, nor do we offer any type of tax advice. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So a few things I want to make sure that people take away from this presentation today, although they are certainly varied. How employees dictate plan choice. That's a big one when it comes to actually setting up a business type retirement plan if you're a small business owner. Granted, not every single person here potentially is going to be an owner operated business. Some of you might have some employees, and we need to correctly define what an employee is and how that might dictate which plan you might want to choose. There are many different options for how you contribute to these plans. Some are pre-tax, some are post-tax, some are corporately deductible, some are personally deductible. And we'll certainly go into all of those. And then also the tax implications for certain types of contributions. And especially we're going to be covering some updates that we have this year that certainly do help to open up more options for you when it comes to determining whether or not you're going to make deductible or non-deductible contributions. And an easy way of saying that is whether or not you are making Roth versus traditional contributions to a particular type of retirement plan. A little bit about Advanta IRA. We're very proud to be going into our 20th year in business. So at the end of this year, we'll cross 20 years in business servicing clients. We service clients all over the United States and the world. So if you are located in a state other than the ones that we operate directly in, which are the Carolinas, Georgia, and Florida, it's not a problem. We have clients that span all 50 states and across the globe as well. We currently administer almost $2.6 billion of client assets with almost 10,000 individual IRA accounts under administration. It's a milestone that we're pretty proud of, and it goes to show that we certainly are able to kind of handle really whatever our clients throw at us. We've had experience doing investments across basically anything, so long as it's not a publicly traded stock or security, we can more or less handle it, and especially have a large track record of helping clients that are small business owners better prepare for their taxes and also open up many more options to them as well. And we also offer dedicated client account management to any account, no matter what the size is. So if you are just starting out with a $5,000 contribution to an IRA, or if you have a multiple of that in some other type of plan, we're certainly equipped to handle that. And we also offer dedicated service to each and every individual that comes into our platform. So what is an employer-sponsored plan? You're going to hear me mention employer-sponsored plan quite a bit throughout this presentation. And what an employer-sponsored plan is a type of plan that has to be attached to a business. Now, for the purposes of this presentation today, we're going to be covering the 401k, which some people might also refer to as a solo 401k, and I'll probably refer to it as a solo 401k at some point as well. Just keep in mind that this is a 401k that is distilled down and utilized for owner-operated businesses or individually operated sole proprietor type businesses. We're going to be talking about SEP IRAs and simple IRA plans. And these types of plans are what have to be married up to some type of business activity Not just anyone can go out and open up one of these types of accounts. If you are someone that just works a W-2 job and has no other type of self-employed income or other type of derivative income outside that business, you can't just go out and open up one of these types of accounts. So remember, the plans that we're talking about today have to be attached to some type of business activity. Now, that doesn't mean you have to have something as formalized as an LLC or a C Corp or anything else like that. If you do have some type of business activity, and that could be something as simple as selling widgets on Amazon, it could be something as as in as formalized as running a laundromat. Some type of formalized business income is what is going to determine your ability to have an employer-sponsored plan. So again, I just want to make sure that people understand when I'm talking about employer-sponsored plan, what exactly that's referring to, and that's going to be the solo 401k, the SEP IRA, and the simple IRA. And these types of plans have been around for many, many years. Some of them have different aging than others, but the 401k and IRA accounts in general have been around since the mid 70s. Granted, the SEP IRA coming to us in the early 2000s, the simple IRA coming in the late 1990s, and the 401k coming all the way back in the 70s. So these types of plans have been around for a significant amount of time, but obviously understanding how they work is going to be very important. But nothing we're going to be covering here, with the exception of some newer tax updates, is inherently anything cutting edge or something that you don't have the confidence that people have done for many years and is well established and accepted. So what are some of the key components of an employer plan? As I mentioned, there has to be some qualifying activity, and there are components that you need to understand, and we'll get into those here. So first off, you have to have a sponsoring business, and that's basically a fancy way of saying there has to be some type of business activity that the plan is married up to. It's the entity that creates the plan for the benefit of the employees. Now, when I talk about employee contributions or employee X or employee Z, that just means the individual that's interfacing and doing the business activity. Now, this can be you as an owner operator. You are your own employee, so don't kind of get confused in the fact that when I say you have to have employees or I talk about an employee contribution, that means you have to have hired someone, you have to have someone working for you. It's just the correct terminology to use, and I always like to be specific in that because I encourage people to do their own research and go out and understand better what they're going to choose. And when you read anything from the IRS, it's always going to refer to employee versus employer contribution. So just understand that's where I'm coming from with the verbiage that I'm using. So the sponsoring business has to be there. And that can be something as simple as a sole proprietorship. It could be an LLC. It could be a corporation. It could be any of these things. But you have to have that. You as an individual with no other business activity can't just elect to be a sponsoring business. You have to have some type of qualifying business. So that's kind of the first step in understanding who can have these and what goes into it. Next, you have to have participants. You have to have some type of activity in the plan. Now, when we're talking about employees, this can be the business owner, the spouse of the business owner, and several others, which we'll get into when it comes to who can be excluded from this, who would have to be included in a particular type of plan, and determining which plan is going to be the best fit for you, because some, namely the 401k, have specific regulations once you have what are called common law employees that might dictate which plan you want to choose. But again, you have to have a sponsoring business, you have to have someone participating in the business, and then you have to have contributions. It is a little bit of a gray area to say that just because you have the plan, you have to participate in it, but there certainly does need to be the ability to participate in the plan. If you just have a stagnant LLC sitting around that you have no intention of ever contributing to or being active with, attaching something like a 401k or an LLC to it might not necessarily be in good faith. And granted, the IRS doesn't have specific regulations on this, but again, it's always best to act in good faith when it comes to doing anything with tax that has taxable implications. But in general, it's a good guiding principle to say, hey, if I'm establishing this, I want to do it with the intention of making contributions. Now, you don't have to make contributions to every single one of these plans every year, with the exception of the simple IRA. But having the intention and the ability to do so is definitely a good way to go forward. So this can include voluntary funds contributed from each employee, meaning an elective deferral in which you contribute out of your own compensation. It can be non-elective contributions made on behalf of the employer to the plan for the benefit of the employees. Think simple IRA and SEP IRAs. And different plans are going to have different limits and formulas for making these contributions. So again, before we move to the next slide, if you're just listening in and not watching, you have to have a sponsoring business, you have to have participants or employees in the plan, and you have to have contributions in the plan as well, or at least a reasonable expectation that you can or will be making contributions, although you don't necessarily have to make them from year to year. You do have flexibility depending on what type of plan. So those are the key components of an employer plan. And one. So understanding the different types of plans is also important. They're not all created equally. They all have specific use cases in which ones might be better for one particular individual versus another. And also do keep in mind, although we haven't had anyone chime in yet, if you do have any questions, feel free to fire those in. I'll get to them throughout the presentation. So just make sure you type into the chat box if you want some more clarification. Granted, we haven't gotten into any of the more complicated stuff yet, but we certainly will. So understanding the different choices is also going to be very important, because not all of these plans offer the same benefit. There are going to be some plans that are much better suited to certain individuals, namely depending on how you derive your income from your business activity. Maybe if you have employees, maybe if you want different levels of deductibility or different options when it comes to how you make contributions into that plan. Each one of the three types of plans that we're going to cover will offer different benefits. And they're also going to directly indicate how you contribute cash and how you administer those plans as well. Now, some plans allow for corporate deductions, and some may also allow for personal deductions. Namely, the personal deductions are going to primarily be derived from your simple IRA and your solo 401k. Now, I'm not a huge fan of simple IRAs. I think they're overly complicated for no other reason. And if you're a sole proprietor or a single business operator or an owner-operated business, the solo 401k, I feel, offers a little bit better flexibility and pretty much the exact same way to make contributions, but with much higher contribution limits. And some require employee contributions to receive, some require employees to receive an employer contribution in matching to the employer contribution, and some do not. So just keep in mind, every single thing that we're going to be talking about here today is going to be inherently self-directed if we're administering it. So the options for the investments are going to be based in the individual or the business owner's direction on what they're investing in. It's not something where you're going to be utilizing our service specifically for investing in things like stocks, bonds, and mutual funds. These are all going to be centered around the self-directed aspects of this. All right, we got a couple questions. We'll get to those, and then we'll move on to the next slide. So let's see. For solo 401k accounts, can the employer contribute without the employee contribution? Yes, you can. You can do one or the other or both. It doesn't necessarily have to be a matching dollar for dollar. The simple IRA, depending on which option you elect for, might require a combination of that, a matching contribution, a non-elective to match the contribution coming in. But if you're a solo 401k owner or user, you're not necessarily required to put in the front end elective deferral if you want to make the back end contribution from the employer. And let's see, can a single member LLC owner have both a 401k and a SEP IRA and contribute to both as an employer? I typically tell people that you should probably choose one or the other. I have interacted with some CPAs that feel that doing both could be a viable option. In my opinion, and this is just me and my professional experience, doing one or the other is going to probably best suit you. Talk to your tax advisor, because certain instances, depending on how you actually have established your business, might allow for multiple plan coverage. But for the most part, people are going to be much better suited to just utilizing one versus the other when it comes to actually establishing and utilizing a particular retirement plan versus another. All right, great. So we answered the questions, and now so moving money between these plans, because understanding the establishment of these plans is always going to kind of build on a base of what exactly you're doing. So if you have a existing traditional IRA, or you have an existing old 401k or something like that you would like to utilize to roll over into one of these matching types of plans, it's basically as easy as either doing a transfer or a direct rollover. Now, neither of these types of movements are going to be taxable. Some of them aren't even reportable. You're not paying penalties to move funds between one type of retirement plan to another. It's simply going to be basically just a mechanism that we use to move funds between them. So a common thing, and the reason that I might put something up here that might seem as elementary as moving funds between these types of plans, is that I get asked the question on a weekly basis of, well, if I do this, I'm having to pay taxes and penalties to do it. It's certainly not the case. Doing a new business plan or starting a self-directed plan of any type is simply doing just an alternative. It's just an alternative way of investing your funds that is not something that your larger wirehouses will allow for. It's the exact same type of plan you could get from them, just with more varied investment options and administrative options as well. And again, direct rollovers, this is the mechanism you're going to use if you have an old retirement plan from an old employer, like a 401k, 403b, 457, TSP pension, etc. Something that is going to be utilized in that fashion. It's done via a direct rollover. And it's just important to understand the terminology that kind of goes behind each of those options. Now, again, from here on out, we're going to be focusing on 3 different types of plans. The simple IRA, which is kind of a horrible acronym for a rather complicated plan to administer that doesn't offer a ton of benefits, but it definitely still has a use case. The SEP IRA, which definitely had some very big updates in the Secure Act 2.0 piece of legislation that was signed into effect at the end of last year, which we do have provisions that are going to be utilized in this calendar year, which we'll get into, and the individual 401k plan, which is one of my personal favorites. I really believe it allows for the owner-operated business or the sole proprietor the most options when it comes to how they contribute to the plan, being able to maximize the amount of money you get to put into a plan given a certain amount of income. And we'll show you kind of a really cool use case on an individual making $100,000 per year on just how much more money you can put into a plan, making the exact same amount of money utilizing each of the 3 plans. It's a pretty cool way to look at it when kind of figuring out which one is going to be the best choice for you. And granted, some of the new tax law updates that came about with the Secure Act 2.0 maybe make one plan a little bit more attractive than the other. Whereas I used to kind of really focus on the individual 401k plan as kind of one of the gold standards. The SEP IRA has really come around with some of the additional options that we have with that. Now let's look at plan contribution limits. This is what a lot of people like to look at. We did have some updates this year, and especially when it comes to the SEP IRA, Simple IRA, and the Solo 401k. But just for the sake of argument, I'd like to put them all up here so people have a well-rounded understanding of what all of their retirement plan contributions look like. Now, we have passed the opportunity for you to make previous year contributions for traditional and Roth IRAs, not SEP, Simple, and Solo 401ks. We'll get into that in a moment. It's mainly the reason that we're doing this webinar now prior to the corporate extended filing deadline. For traditional and Roth IRAs, you're able to contribute $6,500 or $7,500 per year, depending on your age. The demarcation for that extra catch-up of $1,000 is 50, the age of 50. A SEP IRA, you can contribute up to 25% of your compensation, up to $66,000 per year, and you can also factor in your traditional IRA contribution to that. So basically, you get an additional $7,500 kicker into the SEP as well if you would like to, or $6,500 depending on your age. So just keep that in mind, is that while the SEP IRA doesn't really have a catch-up, SEP IRA is considered a SEP component of an IRA. So you can kind of factor in your traditional or Roth, and we'll get into that in a minute, contribution into that total allowable figure. The Simple IRA got a little update as well. You can contribute $15,500 of your personal income derived from that business. So that's what's called an elective deferral, plus an additional $3,500 if you're over 50. And then you also have up to a 3% employer match that can be contributed in as well. The Solo 401k got the most noticeable update with a $2,500 bump on the elective deferral. So what you can add in out of your own personal compensation, plus a $7,500 kicker if you are over the age of 50. And this is in conjunction with a 25% employer match to make up the difference to $66,000 or $73,500, depending on your age, being over 50 or under 50, with that catch-up contribution kicker. ESAs have not gotten updated since I have been at Advanta, going on about 11 years now, almost 12. So yeah, that's that one doesn't get looked at too terribly often. And the HSA got a little bump to $3,805 if you are under the age of 50 with a $1,000 catch-up for an individual plan, or $7,750 if you are covered by a family high-deductible healthcare plan. Now, the investment options for any of these accounts are going to be the exact same as if any of our other types of plans that we have. But I always like to make sure people understand, if you're a small business owner or you're interested in doing the more self-directed options, none of these types of plans are going to limit you in what you are able to do. It might seem, again, kind of simple with the fact that you are here at Advanta looking at this, but I get asked pretty much on a weekly basis, if I use a solo 401k, can I not do this? If I use a SEP IRA, can I not invest in this? Any of the types of self-directed options that we offer for any of our plans can be done by any of these. So things like real estate, single member LLCs, private placements, futures trading, and any other wonderful alternative that you can come up with can be accomplished for these different types of plans. And before we move over, we have to our interesting case study. Someone asked, can employer contributions to a solo 401k? Okay, so let me read this. So can employer contributions to a solo 401k without that year's salary given to an employee? I'm going to answer this the best way I think, and then if you want to chime back in, I'll get to it later. So if you want to make a employer contribution to a plan, can that be vested to the employee? Well, if you're utilizing a solo 401k, it's going to be considered safe harbor, meaning that the contributions made by the employer, so think about the employer match or what's called the non-elective contribution, are going to be 100% vested. So in a way, the employer putting it in there, it immediately becomes the employee's basis within the plan. There's no vesting schedule for that contribution. I think that answered the question, but in the interest of moving on, chime in if I didn't completely cover it, if you'd like some more detail, and we'll keep moving right along. So some self-directed rules. Now, these rules apply to IRAs just like they do 401ks, just like they do SEP IRAs and simple IRAs. So it's important to understand kind of what you can and can't do with these plans. So there's certain things that you can and cannot invest with a retirement plan. Life insurance, term life insurance. 401ks do have the option for certain insurance products, but for the most part, insurance products really aren't an option for retirement plans in general. You cannot buy anything that derives its value from collectability. So think antiques, rare bottles of wine, artwork, stamps, coins. Certain types of coins are allowed, things like bullion content coins, so your American Eagles, Canadian Maple Leaves, my personal favorite, the Australian kangaroos or the Chinese panda bears. Those are all allowable, but those are all based on the bullion content. It's not a intrinsic value of it being rare or collectible. It's just based on its whatever metal content. There are certain people you cannot directly deal with regard to retirement plans. You cannot just deal with a disqualified individual, which is if you look at your family tree, anyone directly up and down from you and your spouse, siblings are not considered disqualified. So just think looking directly up and down in the family tree. These are the people that cannot directly be across the closing table, if you will. So you can't buy anything from them or sell anything. They also can't provide service to an IRA-owned asset as well. If you want some more information on that, I would recommend you look at Internal Revenue Code 4975 or IRC 4975. It goes through everything in very painful IRS detail of what you can and can't do with these plans as far as whom you can and cannot deal with. So I'd recommend looking at it. And then the last thing is that UBIT or UDFI, which stands for Unrelated Business Income Tax or Unrelated Debt Finance Income Tax, is a consideration for all of these types of plans. Now, some of you I'm sure are perking up saying, well, what about solo 401ks? I thought they were exempt from UBIT and UDFI. Only in certain instances. UBIT can apply to any of these plans. So unrelated business income, meaning if you buy a business with a retirement plan, so you set up your 401k or your SEP IRA and you go out and buy a laundromat, that could generate UBIT even for a solo 401k. Solo 401ks are only exempted from the UDFI portion, the unrelated debt finance income portion, when it comes to buying debt leveraged real estate. So it's a very narrow exemption from that tax, meaning that if an IRA buys a property, so SEP IRA or simple IRA, and finances that purchase with a non-recourse loan, then they would have to pay unrelated debt finance income tax. A solo 401k in that same scenario of buying debt leveraged real estate would not have a UDFI liability. That is the only exemption. So if a 401k goes and borrows money, borrows non-recourse debt in order to go buy accounts receivable or goes out to buy, rolling equipment that it leases to a particular business, that is going to certainly subject it to UDFI. So just keep that in mind. It's not a blanket exemption for that plan. And again, that's something I hear fairly often. So it's important to understand where that exemption lies. It is a very large exemption, but it's also very narrow at the same time. And here's a nice infographic of exactly whom you are disqualified on dealing with when it comes to your retirement plans. So anyone listed here, you can't directly buy and sell something to, and they can't utilize a asset owned by the plan. Now you can partner with these people. You can partner with their IRAs. So let's say a mother has a solo 401k and you have a self-directed IRA. You could partner those two plans together and purchase an asset. Let's say you have a self-directed SEP plan and your daughter owns a business and has a solo 401k. You could partner those together in purchasing an asset. You just can't sell something directly to these individuals, and you also can't buy something from these individuals. Other than that, the world is yours to go out and try to make money and do investments in the best way that you see fit. But again, it's important to understand the basics of this and where the rules lie so that you don't run into any trouble. So should you choose a qualified plan versus an IRA? This is really where we're really going to start getting into the good examples of how you can make a decision on which one of these plans is right for you. So with a solo 401k, there's no special discrimination testing for an owner-only business. So individual, owner-operator, or their spouse, once you start getting into businesses that have common law employees, we'll get to that in a moment, then you're going to have definitely a different lens to look at which option is going to be best for you. So just keep that in mind, and we'll define what a rank and file employee is because the definition changed about, well, it's crazy to think that 2018 was 5 years ago, but that's when it did change with the initial Secure Act that was passed under the Trump administration. It redefined what a common law employee was. So keep in mind that solo 401ks are great. They're one of my personal favorites, but they really have a use case that's best suited for owner-operated businesses or their owner-operator with a spouse. Once you have regular non-equity owner employees, they can get significantly more expensive. The benefits are still maintained, but just keep in mind when it comes to choosing, that is definitely something to look at is the type of business you have into which plan you want to elect. Now, SEP and simple IRAs, they can cover up to 100 employees with a simple IRA, and SEP IRAs can have any number of employees. So you could have 5 employees and cover with a SEP plan. You could have 5,000. Although if you have 5,000, I highly doubt you're listening to this webinar, but if you are, hi, I'd like to meet you. So just keep in mind that the number of employees that you have can directly affect your administrative costs for a solo 401k, not so much with a SEP or a simple IRA. Granted, it might directly, change your cost with a SEP or simple IRA because you're telling everyone that you're going to make contributions based on a compensation number on the employer side of things. So the more people you have in the plan, if you're contributing at a high rate, might definitely increase your cost for that plan. But the administrative costs, again, are going to be less when comparing apples to apples of just looking at the amount of employees when choosing between a SEP or a simple IRA and a solo 401k. So what are the impacts of other employees? So as bad as it kind of comes off if you're just listening to a recording, but it's important to understand who can and cannot be excluded from one of these plans, because let's say you have someone that doesn't qualify as a common employee for your business, and maybe they don't necessarily want or have a need to actually participate in a 401k or retirement plan because they need every ounce of money that they're getting. Maybe they're working part-time. But again, it's important to understand who you can and can't exclude from one of these plans. So what types of employees are excludable from an employer-based plan? Anyone under the age of 21, non-resident aliens, and union employees covered by collective bargaining agreements can be excluded from an employer-based plan. So what types of employees must be included? And here's where we had a redefinition a little bit of what exactly an employee is. It used to be anyone that worked over 1,000 hours a year for a business was considered a rank and file common law employee for that business for the purposes of including them with a retirement plan. But for a solo 401k, what we now have to look at is someone that's worked at least 500 hours of service for 3 consecutive years or over a 5-year testing period is individuals that would have to be included for the purposes of a retirement plan if you're going with a solo 401k. So again, we had the inclusion of the 500 hours a year for 3 consecutive or over a 5-year testing period, not just 1,000 hours per year as we did prior to 2018. People that can be excluded from a SEP IRA are those that have worked, or people that must be included are those who have worked at least 3 of the last 5 years, and simple IRAs are those who have received at least $5,000 in compensation in either of the last 2 years. So that's where the simple IRA kind of has its one shining light. And I, like to pick on the example of a surf shop. We're here in sunny Florida, we got a bunch of them. But maybe a high school kid who is working at a surf shop over the summer, they're not necessarily going to want or need to be covered by an employer-sponsored retirement plan. So if they're making less than $5,000 in the summer, granted they might be working, a bunch during the summer, but if they're not making a whole lot of money, you could exclude them from the plan. So simple IRAs are good for individual businesses that might have employees, but maybe have a more transient workforce, hiring people very seasonally, younger individuals that maybe, just don't have a need or a desire to be covered by an employer plan. That's really kind of the one use case that simple IRAs work well for. And again, using the example of a surf shop and some high school kids working there, that's kind of what I like to leave people with that. So those are the people that can be excluded and the people that must be included, broken down by plan type. So what are some advantages of one of these plans versus another? So SEP and simple advantages. Advantages of a SEP and simple are they're less expensive and easier to administer. Granted, the increase in expense is going to be directly related to the number of employees you have. It's not necessarily going to be on the administrative side. So with these types of plans, contributions are made directly to IRAs. You as the employer maintain no fiduciary liability for the actual performance of the assets in the plan, because when you establish one of these plans, even if it is self-directed, the employee is going to be directly responsible for choosing all of their own investments. Or if you've set up one of these types of plans and you have a financial advisory service that's going to be assisting with it, they would take over more of the fiduciary responsibility for performance and asset selection. So if you do have employees, granted, even if they're a very small number, making sure you limit your liability and engage with the plans in a proper manner, that is kind of a point that might be a big one to choose, is that you don't have a fiduciary liability when maintaining a SEP or a simple IRA for performance or asset selection. Individual employees can choose the IRA custodian, so they're not beholden to having the SEP account at one individual financial institution. So if you wanted to self-direct your SEP or simple and do it here, they could certainly open up a SEP or a simple at, let's say, a Fidelity or a Vanguard, and then you can just have your payroll deferral go directly over to that other custodian, and they could choose more traditional investments. So that's one nice thing, is that it gives a lot of flexibility to the employer and the employee about what types of assets that you're administering, where the accounts are actually being administered at as well. And they're very portable from one custodian to another. Employer contributions only to those employees with more than 2 years of service for a simple and 3 years of service with a SEP. So again, the exclusionary principles behind these two types of plans are a little bit greater than you see with a solo 401k. And the reason for that being is that solo 401ks, or 401ks in general, were born out of the labor rights movement in the mid 70s with the passing of ERISA. So there was a lot of sweeping changes that came to unionized workforce and compensation and retirement plan changes with that bill. And that's where a lot of the legislation that we're still utilizing today that's been renewed and codified came from, was kind of that general area. So that's one reason that you're going to see some differences in the regulatory issues between IRAs, which are mainly administered and kind of ruled by the IRS, if you will, and 401ks, which are kind of administered and ruled by two different organizations, be it the Department of Labor and the Internal Revenue Service. So, again, that's why you might see some inconsistencies or differences between the rules on these types of plans is that right there. So a little bit of a history lesson. I find it interesting, and maybe some other people do too. But moving on, 401k advantages. You have potential higher funding limits. Now, if you look at an apples-to-apples comparison of a maximum contribution to a solo 401k and a SEP IRA, they're going to be relatively the same. Again, in a perfect world, if you're trying to maximize either, you're going to basically be seeing the same numbers, but you have a much higher degree of flexibility in how you get to that higher number with a solo 401k. And that's the slide after this, or another one few farther down, where you're actually going to see, utilizing a $100,000 compensation number, how much more money you can get into one of these plans, again, making an apples to apples comparison. You can have large amounts deferred from your income from either the employee contributions or employer contributions. There's a lot of rollover opportunities. 401ks also have the ability to access tax-free loans. So you can take a loan of up to $50,000 or half of your vested balance of a 401k to use personally for whatever you'd like to do. This is not an option that is available to SEP, Simple, Roth, Traditional, any other type of plan. You cannot take a loan out against that plan. Now, some people might be chiming up, well, what about the 60-day rollover rule? Well, that's not really a loan. You're not paying it back with interest. You just have a clock that starts ticking the second you take out money from a IRA, Roth IRA, SEP IRA, and you have 60 days to put dollar for dollar, penny for penny, those funds back into that plan, or it's going to be taxed with penalties potentially. So a 401k allows you to actually borrow against it up to $50,000 or half of your vested interest. You have 5 years to repay the loan, up to 30 if you're using it for the purchase or down payment of a primary residence. And you have to pay at least a quarterly payment, and the interest has to be pegged a point above or below prime. So those are the basics when it comes to 401k tax-free loans, which again is another big benefit. With the uncertainty that goes with everyday life now, it seems, for the past 3 or 4 years, having the ability to get money out of one of these plans and not be under a relatively constrictive timeline is very nice. 401ks also escape UBIT or UDFI more specifically for leveraged real estate investments, an option not available to SEP or Simple IRAs. They're relatively cost-effective administration. Again, if you are an owner-operated business or it's just you and your spouse or you individually, solo 401ks are very inexpensive. Once you start getting into having rank and file employees, so 500 hours a year of service for 3 years or 5-year testing period or 1,000 hours of service in one given year, these plans do get significantly more expensive to administer, so keep that in mind. And you also have the option for Roth 401ks, but as we'll get into in a minute, why I alluded to in the beginning of this presentation, that the option between a SEP IRA and a solo 401k might inherently be getting a little bit thinner, a little bit less defined, is because we also have Roth options for SEP and Simple IRAs as well. We'll get into that here in a few minutes. So here's the really interesting slide that I want to bring your attention to on comparing contributions between an individual, in this case, John, who's a sole proprietor who made $100,000 in a given year. And I think this will really help to illustrate just how powerful these plans are depending on, which one you want to go with. And again, sole proprietor making 100 grand. If you're maximizing a Simple IRA, what does it look like? You can potentially get $19,000 into a Simple IRA. And this could be deductible or non-deductible into this plan. Now, that is made up of a $15,500 salary deferral plus a $3,500 employer match. And again, the front half of this is assuming John's under the age of 50 and a half. With a SEP IRA, 25 grand, 25% of 100,000, $25,000, easy enough. A solo 401k, your potential maximal contribution making $100,000 is going to be $47,500. So you have a significant bump, almost double what you can get into a SEP IRA and a multiple of what you can get into a Simple IRA. It's made up of a a $22,500 salary deferral. So John made $100,000. He decided to defer $22,500 of that into the 401k plan, and he could do as much or as little of that as he'd want to. He also has up to the 25% employer match, or the non-elected match that the employer, I'm using air quotes even though you can't see me, because it is an owner-operated business, so he's using his total net operating income, or his net income for that year, to say, okay, we have this 25% that we're basing on 100 grand. We're also putting in 25,000 as well. So this really kind of shows just how powerful it is getting money into one of these different types of plans if you're looking to maximize it. And again, with the solo 401k, you're drawing from different buckets. It's not solely just based on your compensation. It's not solely just based on the operating revenues of a business. You can play around with the numbers, and you can change these from year to year, with the exception of the Simple, where you are locked into at least 2 years of your election contribution of whether you're going to be doing a 2% matching on the contributions or a 3% non-elective matching based on compensation to the plan. The SEP IRA and the solo 401k allow for every year for you to change the ratio and the amounts that you're contributing into those plans. So that's why I really like the SEP and the solo 401k for small business owners, because again, with the uncertainty in the world, it gives you a high degree of flexibility in exactly how much money you're putting into one of these plans per year. So you could drop that down to 1% or 0 1 year. You can maximize it the next year because you're always going to need to, maybe you need more capital for your operations. Maybe you need to buy more inventory. Maybe, life happens. The ability to change these contributions from year to year or have a high contribution for many years is very important. Now, if John is over the age of 50 in a given year, he has catch-up contributions. So in this case, he could contribute an additional $3,500 to a simple plan, or for a solo 401k, he can contribute an additional $7,500 into the simple IRA, the solo 401k. So if he's over the age of 50, he can potentially get more than double dollars for dollar, apples to apples comparison into a solo 401k than a SEP IRA. But not to say the SEP IRA is inherently a bad choice when compared to a solo 401k. It's just different needs dictate which plan is going to be better. If you are making a high amount of ordinary income, the ability to defer based on the total dollar figure might be more attractive to a SEP IRA holder. People like realtors or salespeople really like the SEP IRA for its simplicity of just saying, hey, took my total compensation, I'm going to contribute in and just take that deduction and reduce my amount of shown income for a given year. Solo 401ks are really popular with people like real estate investors or private equity investors, or just people in general really like the solo 401k because it has those two different components. You're not just looking at total compensation. You can say, hey, I'd like to pay myself out some salary, completely write that off, and then also contribute a portion of my net operating income into the business as well. But the downside is that you have to, a 401k doesn't let you just show no income for a given year and still make that 22.5 salary deferral. So again, playing around with these and figuring out what your best use case scenario is going to be very important. So getting away from looking at just the dollars and cents of everything, let's look at how these plans are administered. So with a 401k, another reason why I like these is the fact that it gives you a large degree of flexibility in how you administer the plan. You can do it all yourself. We call it a DYO, do your own. You can administer it partially with Advanta, doing the cash administration and the asset administration. You could have Advanta doing all of the administration plus the plan reporting on what's called 5500 EZ. So you have a lot of different options on how these are administered. Unlike a SEP and a simple IRA where they have to be custodial accounts, going back to the regulations from the IRS versus the IRS and the Department of Labor and fiduciary liabilities to these plans, 401ks, although you do have a fiduciary responsibility as the trustee of the plan, if it's a solo 401k, you're just a fiduciary to yourself, so it doesn't really make a difference. But if you have employees, that might be a consideration. But it gives you a lot of flexibility when it comes to how you administer these plans. So the cash and assets can be administered by Advanta if you want. If you don't like, if you throw a receipt into your pocketbook or your wallet and it immediately goes into a black hole, having us do some of that administration is probably a good idea for you. But let's say you are really good with record keeping. Let's say you run a one-stop shop bookkeeping business. You could do the whole plan yourself and really cut down on your administrative costs. In either scenario, John would be signing everything as the trustee of the plan. DYO plans, do your own plans, have a trust account at a local bank so you can directly write checks and maintain what's people like to call checkbook control without having to utilize any tertiary entities like an LLC or anything else like that. You can do checkbook control and administer a 401k directly yourself, an option that is not offered to any other plan without setting up additional entities, which is a really cool function. And then for any of these options, you have all of the income from the investments directly going back into these accounts, completely non-taxable. Now, again, the taxation is going to be based on the distribution side on whether this is a pre or post-tax account, meaning Roth or traditional. So there's something to keep in mind, but the 401k offers a greater degree of flexibility when it comes to contributing to these plans administering these plans directly. Now, we're going to be getting into some of the new opportunities for Roth investment, which is something that we don't get to give the government a lot of credit for doing something that really acts in the best interest of the investors and the taxpayers too often, but they definitely did some really good stuff here in giving higher degrees of Roth options to investors and small business owners. And this is really pretty cool. So previously, all employer contributions to SEP and simple IRAs had to be made pre-tax, meaning that they were always going to be deductible. The only plan that allowed for after-tax contributions directly into the plan was the solo 401k. So it made a lot of sense that people that wanted to do Roth contributions went to the solo 401k, even if it was at a slight detriment to their overall tax planning strategy, because it offered that after-tax flexibility. No longer, as of January 1 of this year, you are able to make contributions to these plans on a post-tax basis. So you can say, hey, you know what? I don't want to claim a deduction for the contributions going into a SEP or a simple IRA. I want to make it as a Roth contribution. You can have a SEP Roth and a simple Roth now. And again, it's going back into the ease of administration. SEP and simple Roth IRAs have very easy administrative overhead, so you can make these after-tax contributions and kind of just be done with it. There's really no additional thought that goes into it. It's a pretty simple option for that. Another option is that any unused 529 plan funds. So if you or someone with a child and they had a college 529 plan, and the plan is 15 years old, let's say they decided to go to trade school, or they opened up their own business and didn't go to college, or any other number of options. If you do have 529 plan funds, you can directly roll those over into a Roth IRA now. So that's another big thing as well, or a Roth simple or a Roth SEP. So just keep in mind that we do have some more Roth options with that. We also have some 401k changes and improvements this year as well. So you have automatic enrollment for eligible participants that start at a minimum of 3%. So keep in mind that if you do have employees, now you will have automatic enrollment that has to be done. It's not based solely on the individual that is participating in the plan. Roth 401ks no longer have required minimum distributions. This is a big one. Roth 401ks used to have a required minimum distribution, which was kind of a pain for people that were over the age of 72, because if you've already paid tax and you're going on the assumption that everything is going to be uniform with Roth IRAs not having a required minimum distribution, you were wrong. They brought this into consideration with the current Roth IRA rules, and now Roth 401ks no longer have an RMD. Now, getting into filing deadlines and plan establishment, this is another thing that greatly helps individuals, especially when it comes to determining which plan is best. So with a SEP IRA, you have up until your filing deadline plus extensions to establish the plan and make a previous year contribution. So if you're filing taxes, this year for last year, 2022, you can still set up a SEP plan and make a previous year contribution to reduce your taxation for last year. And that has been well established ever since I've been doing this. So for at least a decade, that's always been the case. 401ks have gone through some incremental changes with regards to when you needed to open up the plan, when you could actually make certain parts of the contribution, X, Y, and Z. So with a solo 401k plan, if the plan is established by 12/31 of the year prior, you have up until your filing date plus extensions to make both contributions. So your elective contribution of your compensation and the matching contribution, or the part of the net operating income business contribution. You have up until your filing date plus extensions, so long as the plan was established by 12/31. Now, if you establish the plan after 12/31, you can still make previous year contributions. You're not out of the, that's not you'll just lose out on that. But you had to have had the plan established by 12/31 to make the elective deferral compensation contribution to that plan. So a lot of more flexibility being built into these, which is really awesome for people making a choice with these plans, because especially, I know I'm guilty of it too, waiting to the last minute before filing taxes. The SEP IRA often was good for people that kind of waited and kind of put things off, because it allowed for that, day before I got to file my taxes, open up the plan, contribute, and you're done. 401ks now basically have the same, solo 401ks basically have the same flexibility for you as well. An employer non-elective contributions can now be made directly to a Roth basis to the plan. Previously, with a 401k, you had to make the employer contribution deductible and then convert it in plan. Now you can just dump everything into the Roth portion of the plan without having to do any type of conversions after the fact. So definitely streamline some stuff. And for the most part, I'm a big fan of what happened with this. Single member LLCs and sole proprietors, again, making elective deferrals to the solo 401k plan. We covered that. Participants of a 401k plan who have active student loans. Now, this might not necessarily hold true for probably a lot of people on here. We don't get a whole lot of younger people, but if you are, if you have children and you're talking to them and they're getting out in the workforce, I like to include this as a carryover from some other stuff that I've done, is that you can now treat participation in a plan by virtue of making your student loan payments. For example, when I first started my career, I made the choice to contribute to or to pay my student loans versus contributing to my 401k plan, which lost out on the free employer match money. Now you can treat your payments to a student loan as participation in the plan and still get the benefit of the employer match without actually having to put anything into the plan. So, kind of a really good thing. We're still not exactly sure how this is going to play out for the sole proprietors and single member LLCs. We're waiting on guidance from the government as to how that would affect anything. But again, I'm not exactly sure it would really have too much of an effect, as these are safe harbor plans, and you get to contribute at your own discretion to the plan in general, and they are and the contribution rate at which you defer in that 25% of the net operating income and the elected deferral, those two things are divorced anyway. So again, not necessarily sure how this would affect anything unless you are filing as a C Corp, in which case it would be a little bit different. But most people on here, I would assume, are not filing as a C Corp. They'd be doing it as an S, a LLC tax as a partnership, or just doing it as a sole proprietor, passing all revenues directly to their personal income statement. Lastly, you're all able to certify hardship withdrawals from a 401k plan, and they've created a national lost and found network to help taxpayers find money from old employer plans. So that is, kind of the big ones. And okay. And lastly, I just want to kind of go through the considerations for leverage within these types of plans. As I mentioned before, if you are someone that's interested in doing real estate or debt leveraged real estate, understanding how that is done properly is very important, because 401ks are the only ones exempted from those taxes. So any type of retirement plan that we've covered today can use leverage. It has to be non-recourse. UBIT and UDFI are going to be calculated differently, and if you are doing debt leverage, it is going to be UDFI that you have to be considerate of. 401ks, even with all the tax law updates, are still the only ones that are exempted from that type of tax. So if you have a SEP or a simple IRA, even if you're doing the new SEP Roth or simple Roth, it doesn't matter. If you're going to be utilizing debt leverage within one of these types of plans, you are going to have to file a tax return. 401ks, again, very big benefit. One of the reasons I really like it, because I do believe in real estate investing, is the ability to do debt leveraged real estate purchases without any additional tax. And really the only consideration you're being given is, the terms of the loan and the debt servicing that goes along with it. So with that said, that's where I kind of want to leave it off today. I like to always try to get these webinars done at the top of the hour to respect your time. If you want to learn more, we do have weekly events. We catalog all of these on our video library. We maintain a blog, and we also have a podcast, which I personally host, the Alternative Investing Advantage podcast. If you're interested, it is available anywhere where podcasts are available. And if you'd like to get started, especially with these plans, I would recommend scheduling a consultation with someone like myself or one of my colleagues. You can get in touch with me directly, and we can get you helped out with that, because these are significantly more, in-depth plans. And especially if you want to establish something before you file your taxes, it's definitely a good idea to kind of get that ball rolling now, so we can get something in place for you to get the contributions made and file your taxes properly. With that said, I'll open it up to any questions. I'll stick around so we have just a few people left on the webinar, but I do appreciate everyone being on with us today. Sorry for the small bit of technical difficulties we had in there in the middle, but I think we picked it up relatively easily. So again, any questions? But that is the end of our presentation today. If you do want to grab a copy of the slides, they are attached as a handout to this presentation. You can grab them right there, or email me directly, and I'd be happy to send those over to you as well. All right, well, seems like we have a bunch of people dropping off, so if there's no more questions, we'll go ahead and end it up. Again, thank you everyone for joining us today with another presentation from Advanta IRA's webinar series. My name is Alex Perny. Have a great day.